All right, welcome back everyone to another week of In the Charts. I'm joined here by my co-hosts Diogo Monica and Breck Stodchill. And this week I get the honor of starting because Diogo ran the randomizer on the website and I was chosen as the one today. So I'm gonna kick us off with the chart and let me get that up here. Just give me 1 second. All right. I've got another chart here, courtesy of our friends at Artemis. Let me actually make this a little bit bigger so that people can see a little bit better. Can you guys see this okay?
Yeah.
All right. So what this chart shows is the top inflows and outflows out of the major top 20 crypto networks. And I just selected year to date. And I thought this chart was really
Yep.
interesting
Looks
because it
good.
gives me a little bit of a narrative violation relative to what we've been hearing in terms of inflows and outflows all year. So let me just walk you through this real quick. So on the left-hand side are the top inflows year to date, which means the amount of capital that's flowed into a given network since January 1st, 2025 up until the beginning of June. And the top inflow is actually Ethereum, where they have inflowed $26 billion. Arbitrum is next with 6.7, et cetera, et cetera. The next here, we got top outflows. So this is all the capital that's left this ecosystem. And Ethereum was again top at 24.4 billion. And then here you've got the net. So inflows minus outflows. So Ethereum had a net inflow of 1.6 billion throughout the year. And then Arbitrum was the largest net outflow at 3.1 billion per year. I think it's pretty interesting here. There's a lot of things going on. So I think the first thing that caught me off guard was if you had been paying attention to the rhetoric on Twitter, you would have thought that Ethereum would be this right here, which is Ethereum is dying. There's very little things happening on the L1. Everything is moving to rollups. Rollups are parasitic to L1s, and therefore Ethereum is lost and doesn't have a future. Second thing I think you would have heard is, Solana is doing incredibly well, Base is doing incredibly well, and they are, right? Like they've gotten a lot of inflows, but I think it's surprising that Ethereum had the top net inflow. Um, and then I think the other thing that's interesting is, you could kind of flip between different time periods. So even if you look at the last 3 months, Ethereum is still the top net inflow. And, it looks like Arbitrum had a pretty big outflow in Q1 because over the last 3 months, it's been Chain and OP Mainnet that have sent the most. I think the last thing that I'll highlight here is that let's go back to the year to date chart. So if you actually click on where the inflows came from, a lot of it actually has come from Arbitrum and from Optimism and Chain. So this is really interesting because you're starting to get capital flowing in the other direction of what the narrative would tell you, which is going from L2s back to L1. So I'm going to pause here. I think there's a lot of things going on. I'd love to hear you guys' reaction to this.
Well, the fears and the narrative of Ethereum's demise has been grossly exaggerated. I generally agree with that. On the other end, in crypto, usually price follows narrative, right? And so the narrative is actually one of the most important things, and people do move projects on narrative alone. I do think that the stats do back what you're saying. I also think that a lot of these things are just like one project moving around. There's lots of ways of having the data be distorted, as we've discussed on the RWA one, right? Where there's one dominant place that just takes 60-70% of the volume. In fact, one of my charts was going to show this exact thing on Ethereum, which is for lending markets. The only thing that matters is Aave with like 65 to 70% dominance, and really on Ethereum, right? And so I agree with the general gist that this is a little bit of a narrative violation.
Yeah, what this got me thinking about was, at the end of the day, blockchains are just asset ledgers. I think that's one of the Kyle Samani-isms. And, what are the right things for us to track if we reduce chains to ledgers? And I think inflows are one, outflows are another, and the other one is issuance. So what native assets are being issued? I think if you were to map that onto this chart, you probably would see that Base and Solana, probably Solana, and then Base would be the leaders here. And you kind of start to have what looks like, what you'd see in like a board deck for a SaaS company where you've got net new customers, you've got expansion, and you've got churn. And I think it would be kind of interesting to talk about blockchains in that way. There's a lot of conversations right now about, what's the right way to value chains based off of what multiple? Is it rev? Is it fees? Is it something else? And I think maybe this could be an interesting thing to think about, just tracking for um, like a leading indicator for some of these downstream metrics to track. So that was the first thing that came to me, because we never really look at this stuff, but I think we all kind of know implicitly that whoever's leading an asset issuance is going to have maybe more activity downstream. So I
Yeah,
thought this
so
was a cool
feature
chart.
request for Artemis.
Yeah,
Just do
that's
our
right.
SaaS-like dashboard. We want to see churn. We want to see net retention. We want to see we want to see
Yeah,
attach rates. Come on,
I
create
think
a
that would
chart
be
for
great.
us.
That would be great.
Yeah, I think the net issuance is a really good point, Breck, because that's what tends to be the innovation and the leading indicator for a lot of things. I think it's interesting to extrapolate what Ethereum's role has evolved into today, which is that, I mean, it's clearly still the dominant place. You might go to another chain because there's something cool happening there. There's some new meme coin, or there's some new asset issuance, or there's some new trading platform that becomes interesting. And then when the fever pitch of that dies down a little bit, I think the default of where you go back to seems to still be Ethereum 01. And so maybe it's kind of like the Grand Central Station, right? It could be the transit hub. And, if they do a good job of actually scaling the L1 again, you could have more people actually stay there too. But today, it still definitely serves as the transit hub, which is, if I don't really know what I want to do, if there's something super exciting, then like the default place I go to, and then it's the jumping off point to the next exciting thing.
Agreed. Okay, next chart.
Let's go.
Would you bring us, Breck?
We're going to talk about driverless vehicles. Okay.
Love it. Love it. Let the banter
So
begin.
okay, so this is a chart that I got from you can see in the bottom left, the Bond Capital AI report, which for those who have not checked it out, I highly recommend. There's a lot of really useful nuggets in there. But today we're going to focus on Waymo's penetration in San Francisco for rideshare. So beginning of the chart, it starts in August 2023. You can see that Lyft had the vast majority of market share in San Francisco, something above 65%. And then Lyft had the second, around 30%, and Waymo is 0. Fast forward 20 months, and Waymo has actually surpassed Lyft and is approaching 30% market penetration. And Lyft has actually gone down like probably sub 20. And Uber is, also declining down towards 50%. So if you even just look at this chart, in the next year, Waymo is going to be on the path to be the number one rideshare app in San Francisco, which is kind of crazy. I can remember when I first moved to San Francisco in 2016, and everyone was like, driverless vehicles are going to be 18 to 24 months away. And it kept like that was all, it kept feeling that that was always the sentiment. And now it's actually not 18 to 24 months away, but it's here. And it's happening not just in San Francisco, it's in LA, it's in Austin, it's in Phoenix. Um, and I think it's cool. And I was kind of reflecting on this a little bit. And Chris and I were talking about this in the office yesterday. My habits are pretty dumb when it comes to rideshare. Like I'll say out loud, I'm gonna call an Uber. And before I've even opened an app, I've trained myself to be like, I'm calling an Uber. That's the thing that I'm calling. And so the first thing I do is I open the Uber app. And I was just doing a little bit of surveying, like the scene this morning. If I wanted to go to Market Street today, like how much would it cost? And Uber's the most expensive actually, because they push comfort onto you now, and comfort is not a very cheap option. And so I'll default to Uber, and if Uber is too long of a wait line or feels like it's too expensive, then I'll go to Lyft, and I'm now a more intentional user. And Lyft is always the cheapest and always the fastest, which is kind of interesting. And then Waymo, I'll only actually call if I have a visitor. because it's more of like the novelty component for me still. I've started to use it if I'm going to be using it for work, like if I need to go to a work meeting, just because it's easier to take calls in between. Um, but like, I don't know. I wanted to ask you guys. I know that we've talked about this uh, between the three of us, and I've gotten a little bit of flack for it because I've generally been a Waymo hater, but the data shows otherwise, and I think the experience has gotten a lot better. So I just wanted to pause and see what you guys think.
So a couple of impressions here. So one of the things that is surprising, I think the absolute number, over 25% of gross bookings are Waymo. That's actually a lot higher than I thought it was going to be. And in fact, I think it's a little bit of a surprise. The graph of bookings growth actually looks somewhat linear, and it began way earlier than I thought it did. And so maybe I was just not early into the beta, but my feeling here is that the growth over the past 6 to 9 months has been much, much more accelerated. So I was expecting a little bit of more of a hockey stick type of bookings growth here rather than sort of a linear increase. So that was also a surprise to me. So the absolute number being higher than what I expected, but the growth actually being lower in terms of, relative growth to itself. So kind of like the function of growth. Lyft becoming irrelevant is not a surprise. I don't remember the last time I saw a Lyft or took a Lyft. So that one is unsurprising to me. And obviously Uber being dominant is extremely surprising. As far as like my personal habits, a lot of part of the reason why I take Waymo is I want it to succeed. I want to give money to the thing that I actually want to happen. And one of my biggest frustrations is the fact that there's a lot of regulatory qualms as to why this is not in all cities, and very quickly we should push for this. And so every single piece of data, every single dollar, every single successful ride that you give them means that humanity actually moves forward faster with less accidents, less death rate, and just a better experience overall. Personally, I actually
Dude, you're
enjoy.
way more selfless than I am. I'm just like, get me to where I need to go, and it's depending on where I'm going, either in style or as fast as possible.
No, I'm sure you do this. A lot of the folks that got electric cars in the beginning were a little bit just, they wanted to support electric cars because the experience was just terrible. And, range anxiety was way, way, way worse. And to a certain extent, the last car that I purchased was actually an electric car. And it was not the rational decision for me for it to be an electric car, but I really wanted to be on the side of the electric. So I don't know if it's 10% there, selflessness, or 20% or 50%, but there is some amount of it. It's not all of it, but there's some amount of it. I do think the experience of Waymo is much better. No driver, no bad smells, just really cool. I always feel really cool, like I'm in the future. So that's why I love it.
Yeah, that last point was actually the thing that I was going to talk about, which is, I think if you were to ask somebody who's never taken a Waymo before, what do you think is the benefit of an autonomous taxi effectively? And I think what they would tell you is like, oh, there's no person inside and therefore it should be cheaper. Right. And maybe there's no person inside and therefore, if I need to catch a 6 a.m. flight and I need to call a taxi at 4 a.m., it's still driving around versus like a person who might be sleeping at that hour. And so I think these are the benefits that it would have just instinctively thought of. But actually, in the very beginning, Waymos were more expensive than both Uber and Lyft. And yet they were experiencing this really rapid market share gain. And part of that is like the novelty factor and the philanthropic nature that Diogo was talking about, where you want to support the thing, but the novelty of that wears off. And I actually think we started to see some other benefits that were unexpected, which is, oh, actually not having a driver means that, if I'm trying to take a car and I don't, want to talk to somebody at 4 a.m. because like I want to sleep on my way to the airport, then, it's probably more convenient for me to take a Waymo or take an autonomous taxi or something like that. Um, and then I think the second thing is that, yeah, the cars just ended up being newer and cleaner and better. And so, there's some
Yeah.
standard quality that you can guarantee with that, which has been great. The other thing that I want to point out is a lesson in just how hard these things are. Waymo was started actually in 2009. I was just looking this up. It started in 2009 as like the self-driving car project at Google. And then it actually became, or rebranded to Waymo and became this current iteration of it in 2016. So here we are 9 years later. They're still only open in what, like 3 markets or something like that?
I think it's four, but
Still 4. So we're still early days. I mean, and they are, a good, what is that? 16 years into this thing.
And billions of
But
dollars.
I mean, many billions of dollars sunk into this. But I think this is a good lesson, right? Because some of the things that end up being the most impactful things are actually just really hard to do. But if you can do it right, and once you release a product that actually fulfills the promise, then the potential energy of that is so massive, and you can start to gain this really rapid rise in market share
Yeah.
for
It's
what is
actually
an
it's an
enormous market.
interesting, it's a big win for deep tech, right? For a long time we were like at the
Totally.
edges doing the next N+1 SaaS, and now deep tech comes from behind and saying no, they're, this graph shows they're going to dominate all of this. It's obviously going to win, and obviously their regulatory apparatus and the fact that they can't go to every city is the thing that's going to hold them back. But hopefully that changes. But deep tech is winning here. Also, I'm curious before we go into my chart. For me right now, one of the advantages of Waymo is the consistency of driving and the safety. I actually feel safer. Like what I would say, like 1 out of 3 or 1 out of 4 rides, I'm concerned about the driving of the driver, either because it's clear they've been driving for way too long, or they just have an electric car and are really heavy handed with the accelerator and with the brake, and so you kind of feel unsafe at times. And with the Waymo, that just doesn't happen, which is funny because there's no driver. Do you feel
Feels
that,
like you're in
or
a
is that
roller
not an advantage?
coaster.
Yeah.
Feels like it's way smoother. It feels like you're either in a golf cart or in a roller coaster. And I like that feeling because you don't really feel like you're on the tracks usually when you're in an Uber, but in a Waymo you do. So that resonates with me. One
Awesome.
other some other nuggets that I found just before we go. So I thought this was really interesting. There's only 600 cars in the bay that they have in their fleet, and that has allowed them to reach some level of network saturation, which is actually a lot smaller than I would have expected. I would have thought that you'd need more cars to be able to be competitive with an Uber and a Lyft. Um, Also, Jaguar has they've stopped production on these cars. So these cars are no longer gonna be, like, out for, your average Joe to be able to go and purchase, which I thought was interesting. So maybe in the future, we'll have a different type of Waymo. And then also the wild card here, Diego, you said that Waymo's obviously gonna win. Tesla's gonna have their robotaxi fleet, and they've got a boatload of cars on the road today. And it's gonna be really interesting to see how that comes out, if they're able to go into new markets, if people are more familiar with Teslas versus Waymos. And I'm really excited to see, outside of the human rideshare wars, what's gonna happen with the robo rideshare wars, because it's coming.
Yeah, it's going to be interesting to see if Tesla is going to be good at services like this, right? So
Totally. That's all I got.
awesome. Let's go into my charts. It's my turn. I am cheating as usual, and I'm bringing you 3 charts. So we should probably rename the thing to in the
Well, it's already in
multiple
the charts, plural.
Fair. Okay, so first up, we have this chart. So first, I want to run as why I'm bringing this chart. So this is CeFi lending market size by quarter end, and it's from a Galaxy Research report as of a month ago. So I wanted to just give the context, as both of you know, the lending markets in crypto have had, turbulent history, let's say. And I thought it was worth going through the recent and specifically crypto collateralized lending. And I'm using this report. It's from Q1 Galaxy, and I think had a couple of interesting insights into the market. I'm going to cover one specific slice of them. And also let me say that for this particular chart, there's a lot of data they don't have here. I know for a fact that there's participants here in the market that are not contemplated. And I think part of the reason is that CeFi data is actually very tricky, much trickier than DeFi for sure, because it's not transparent. And lots of these players just don't share this data, and they're just private companies. But I do think this is directionally correct, even though the real numbers may be off a little bit. So let's start with this first chart. So on the y-axis, we have in billions of dollars of market size. And then on the x-axis, you just have time. And what you see is first, maybe 3 top-level insights. You can see the drop immediately. So crypto collateralized borrowing was very used as a source of leverage in 2020 and 2021 bull market. And we all know how that turned out, right? And we can see the market is much, much smaller post FTX, right? So it's sitting currently at $13 billion with already a recovery baked in, when it was at $35 billion at peak pre-FTX. And there's, I think we're going to talk a little about it. Actually, sources of leverage have migrated. There's other ways to get leverage these days that are not just collateralized, crypto collateralized borrowing. So that's part of the reason why this hasn't come back massively. But just to say that it's much, much smaller than it was at the heyday. The second thing that I think is interesting is the slow recovery. And hopefully that means that it's much more sustainable this time around. But starting from Q4 2023, the market has started recovering a little bit and almost 2x in size, actually a little bit more than 2x in size, which is interesting. But again, like very far off from $35 billion at peak. And then the third one is really interesting, and I guess people don't really know this, is that Tether completely dominates CeFi lending. It has 65% of market share with $9 billion in open loans. And so that's actually extremely interesting here, is that Tether is the biggest lender here, which is kind of surprising. And so that's the first chart I have for you. Do you want me to go into the other two charts, or do you want to comment on this one first?
Well, what is the lending activity that Tether is doing? Do you know?
Yeah, so it's crypto collateralized borrowing. So they basically are allowing people to borrow collateralized by their crypto, right? So they have a lot of Bitcoin on the balance sheet and have a lot of dollars on the balance sheet, and so they can actually like do these businesses on actually either side of it.
The biggest lesson for me for this one, Diogo, is not a single color from 2022 remains in 2025.
No, there's the green outside of Tether. Tether remains.
Yeah. Outside of Tethers, but
Yeah, everybody else failed. I mean,
they're all
remember what
dead.
happens. They're all dead.
Go big
Very
or go
poor.
home.
Yeah, very poor risk management. So that was the first chart. I wanted to show you just relative growth and what happened post FTX. The second chart that I have for you is this one. So continuing on this topic, this is CeFi plus DeFi lending, percentage-wise market share by quarter end. So the same thing. This does include CDPs of stablecoins, which I'm not really going to talk about. But essentially, it shows you roughly that the DeFi lending market share is about 65%. And it was essentially zero in 2018, right? From 2018 all the way to 2020, DeFi lending didn't exist. It really started existing into around 2020. And then the story here is that DeFi behaved extremely well during post-FTX because of over-collateralization and automatic liquidations, as we all know. But I'm pretty sure that the current state of it being 65% of the market share is unlikely to be the natural state of the market. And so what I think is we're not going to see DeFi go down, but we're going to see it go down absolute dollar-wise, but we're definitely going to see it go down percentage-wise when compared to CeFi. So hopefully not to 2018, 2020 levels, but I doubt it will be as predominant in a year as it is today. So that composition. And part of the obvious reasons are, if it's CeFi, it doesn't have to be over-collateralized. If it's CeFi, there's a lot more flexibility in terms. If it's CeFi, there's a relationship and you can use other things for collateral that are just not represented on chain yet. So that's extremely important to keep in mind. So that's the second chart. And the third chart that I have for you is still on this vein, and actually to go to Chris's chart and what he talked about Ethereum. Look at this. This is historical assets borrowed on lending applications by their underlying L1. And you can see that the story here is absolute domination by Ethereum. DeFi borrowings are happening on Ethereum, period. So it's extremely positive for the Ethereum axes, and almost none of the other chains matter. So specifically in the past 2 months, Solana grew the largest relative growth. So they grew 41%. But Ethereum saw the largest growth in absolute terms. So they added $5 billion, which is just around 37% of new borrows. And this is obviously like a story around Aave, right? Aave has 65% of the market in Aave and Ethereum specifically. But it's extremely interesting to see that it's a story. All the borrow, all the over-collateralized lending is a story of Ethereum success. So these are my three charts.
This last chart resonates a lot with me. And I think we could bring it back to Chris's as well. Like if we're thinking about the quality of assets that are flowing onto your chain or being issued onto your chain, the best way to underwrite that is through the lending markets. No one's going to borrow against their whiff. No one's going to borrow against their, fart coin. No one's going to borrow. But when you have a higher quality asset, then the lending market should be more liquid. And I think that's a proxy, but it would be great if we could come up with metrics to understand and start to actually track the qualitative side of some of the assets that live on these asset ledgers. So I think this is a really cool connection to Chris's chart. Yeah.
I also think the CeFi versus DeFi lending is really interesting too. I didn't realize that DeFi lending had, more than half of the share of all lending right now. Uh, I could see a world in which maybe it doesn't sustain to that much, because I think if you think about the advantages of CeFi lending, it's a lot of what you described, Diogo, but the advantages of DeFi lending also is that you're just that much closer to on-chain activity. And so depending on if there's, more on-chain activity begets more on-chain activity. And so to the extent that there are more protocols that you can go to, or more things that you can do with the borrowed capital that lives on chain, as long as you've got competitive rates and as long as it's cheap and it works, that speed advantage may also be important. I'm actually surprised that it's that high today, because that speed advantage doesn't really matter right now. Like, there isn't something super urgent happening on Ethereum right now. It's not like there's, the NFT drops of 2021, or it's not like the meme coin activity happened on Ethereum. And so uh, I'm a little bit surprised to see it, but it's really cool that it's actually just been super dominant like that.
Yeah. So two things, which is post crash. I mean, there's a lot of institutional history here, right? So nobody wants to go back into the same opaque market that they had before. And I do think that the industry has to reform itself quite significantly in the eyes of the borrowers for this to change. And Tether clearly is the majority of the market, and the other ones are. I know that there's actually the real market is higher than this, and other players are in market with actually very significant outstanding loans. And so, it's higher than this, and it's recovering faster, and it will recover faster. However, the story is, number one, institutional history on these crypto correlated markets, and nobody really wanting to use this. In the number two, I think even more predominant, is the fact that since the markets really post FTX, there's new sources of leverage that have become extremely popular, right? Number one, we have Bitcoin treasury companies, which, if you think about it, it's a highly leveraged instrument that you can trade on the NASDAQ, right? And you can also have future contracts that have continued to increase. So if you think about all of these other instruments that you have now that you can use to lever,
Yeah, I almost want
perps,
to
etc.,
I agree
then
with
all of
you,
a
because
sudden
perps
just
obviously
borrowing
have
is
been
no
front and
longer
center
the easiest way to go,
in the last,
and that will
call it,
always
couple
create
of
a
years. And
dampen
I would say that ounces in
on the
favor of
growth
there being
overall
less
of the crypto
DeFi
collateralized
lending
lending,
because
I
of
think,
the
but specifically of the CeFi lending.
supremacy of these on-chain protocols. Because I have to imagine that the core value proposition for borrowing is to go levered long the asset, and perps are a more efficient way of doing that. But yeah, it's interesting.
All right. I think that's a wrap for this week. It's good to get this back on the road, and we'll see you guys next week.
See you next week.
See y'all.